Fiki for Explosive Growth Podcast, where we discuss health, wealth, success, and business. Welcome to the show. Yes, Monday, January 30th. How's it going? Hope you're having a wonderful kickoff to the week. I got a special guest today. Really amazing expert in the realm of tax, deferring taxes, deferring capital gains, and so many other strategies. So without further ado, I'm going to bring forth Brett Swarts. How's it going?
Morad, I'm doing great. How are you, sir?
Oh man, doing great. Thanks for taking the time with us today. I'm really excited about this topic. I love learning about tax strategies and advanced tax strategies to defer taxes or even eliminate taxes. So
yeah, a lot of us feel trapped by capital gains tax when we go to sell, right? And let's face it, taxes that are all-time high, and it's not just about cash flow, it's about tax flow. And to the extent that you understand and have a mindset to understand tax flow and strategy upon the exit, and also upon reinvesting into real estate or other assets, you're going to create and preserve more wealth. And that's what we're here to focus on and help business professionals and high net worth individuals understand this so they can unlock a wealth plan that really serves them and their family.
Yeah, absolutely. I was talking to somebody last week that is considering selling her homestead, and because she's divorced, she was really upset when I told her about the homestead exemption. She's going to get a $250,000 gain on that sale, completely tax-free. But after that, she might be due on capital gains taxes. And, she frankly was thinking like, well, why sell then? Because this is a luxury home. We probably sell it somewhere around 1.2 million, and she bought it around 500,000. So roughly before closing costs, she's looking at a gain of about 700,000. The 250 just doesn't really cut it. What would you advise her or advise someone in a similar situation to maybe defer or eliminate the majority of those taxes?
Yeah. So first, defining the goal, why sell it all right now? Why not just refinance, right? What's the strategy? What are we trying to...
She's got a huge house. She's living there by herself. Yeah. The family's out of there. She divorced. And so, it's a lot of upkeep.
Yeah, it sounds like a good time to sell and a good time to downsize. So she has some clear goals there. The next thing will be, what's the best solution for what she's trying to achieve? Can you defer capital gains tax on the sale of high-end primary homes? The answer is yes. Above and beyond the 250 to 500,000, the answer is yes. Can you just use all of the funds to go back into another property as long as it's investment property? Yes, not a primary. So you just want to kind of define what the outcome, besides just selling, what does she want to do with the capital? A lot of our clients are looking for cash flow, increasing their cash flow, looking to be more passive or active with the funds. So it's understanding what the outcome. But we just did a deal in Palo Alto for $8 million, a luxury home sale. And the client wanted to move to Nevada. They wanted to downsize, but they also wanted to retire. And a lot of their wealth was tied into this asset. And so they were able to purchase just a modest asset outside of what we use. We use a DST to do this. Outside of the DST, they just bought a regular house, and the rest of it became a passive cash flow for them. And so I think the key thing is defining the outcome and defining what's actually possible, and then using that right tool and building that team to help you achieve what you're trying to achieve.
Excellent. So can you talk to us about some of these strategies? So in this case, what she wants to do is take that equity. Let's just say, for simplicity, let's say it's 750,000 roughly. There's going to be some of that eaten up in closing costs, but she wants to take that equity and she wants to buy a new house, all cash, have no mortgage. She doesn't like the interest rates, and she wants to defer or eliminate those taxes. And then the 250,000, which she gets, tax free, then she could, spend that money, reinvest it, do whatever. So yes. What would be the strategy for her to categorize the new purchase as an investment property?
So Morad, what's owed on the property?
She owes roughly $500,000.
Okay, and so she's definitely single, so she has that 250 exemption, and she bought it for how much?
$500,000, 500,000,
Okay,
maybe 20 years ago.
yeah, I'm with you. Okay, did she put any major improvements into the property, like any
And she
major
has,
like?
and she has. I did mention that, like, let's get receipts for everything you've spent on the property. She did some
Mhm.
renovations, kitchens, bathrooms, flooring, roof.
50,000, 100,000?
She didn't know exactly, but she would say at least 100,000 over the years.
Okay, so we're already at $850,000 of basis, right? You see how I got there? Took 500 for what she bought it for, plus the 250 of the 121 exclusion, plus another $100,000 of improvements. So now we're at 850. So we take the $1.25 million, and she's also going to have closing costs, but we'll just keep it there. It's about a $400,000 gain, Morad. Now the question is, what state is she in? She's in Houston, Texas, probably right where you're at.
Yeah.
Okay. So Texas has no capital gains tax at the state of Texas level, right? But
There's no state income tax, correct. In Texas,
yeah, no
there's
state.
no state income tax.
Yeah, so which means no capital gains tax at the state level. Now the federal of 20%, right? So that 400,000, 20% of that is about $80,000 as her tax liability. Okay.
Okay.
So my first suggestion is to make sure she understands that she sells it tomorrow, takes all of the money. She's looking at about $80,000 of tax liability. Okay. Which in the scheme of 1.25 million, I mean, it's still a lot of money, but it's not huge. So we found that the deals that work best for us are $1 million net proceeds, $1 million gain. And for someone who's wanting to go into something passive like real estate. But if they want to use the money for their own purchase of their own primary home, that becomes taxable. It's the same reason you can't do a 1031 exchange into a primary home, Morad, because the government looks at this and says, look, if you're going to grow the economy and you're going to create, more jobs and more tax revenue by going into stocks, bonds, mutual funds, investment real estate, or other business ventures, then you can do it at a tax deferred level. But if you're doing it for a primary use, primary home, it's going to be taxable. So my one suggestion would be, however, she does only owe, you said 250, right? She could potentially do a cash out refi up
She
until her
owes
base.
about 500.
Or 500. Okay, so she could cash out refi potentially up until about 850. Okay. And that could stall the deal or delay the deal a little bit. But then she could take that difference and, refinance is tax free. But then she can turn around and sell the asset and pay off the debt. So it's a little more complex, but that is possible if she has good credit and if the bank's willing to cash out refi right now. There's not a lot that are willing to do that.
But when she sells the asset, they're not going to look at her basis. They're going to say, okay, well, she paid off this loan of $850. She's only due on the tax of, $850 less closing costs and the sales price, as opposed to the basis of $500,000 when she bought it 20 years ago.
So the basis is going to be an adjusted basis of 500 plus the 250 exemption plus the 100 in improvement. So 850 is the adjusted basis. So it's 125 minus the 850 is her gain of 400. And that's what it's going to be based upon. But if you do a cash out refi, you can get some money out tax free, and then the debt can be paid off. We just can't borrow in excess of the adjusted basis. So this is kind of technical, but it's important to understand those nuances there. So every deal is a little different. This is part of why you want to build a team. You want to work with their CPA. You want to really break it down to what they're trying to achieve and what's possible. So she could cash out refi up until her basis, have her check with her CPA. In this scenario, I think her basis is about 850. So in this scenario, she could potentially borrow up to 350 if a bank's willing to give her a cash out of that amount. Then you could turn around and sell it for 1.25 million. She still would have tax of 80,000. Okay. So it's not like you're eliminating the tax unless she put it into something that's a tax deferred strategy, like a deferred sales trust. We could put her into that, but then she could use at least the 350 that she did the cash out refi for a down payment. We have a lot of people that want to buy this thing all cash, right? It's been their dream. They want to, buy it all cash. They also don't want to borrow at a higher interest rate. But this is the question you ask, Morad. Would you go borrow at 20%? right, to pay off debt at 6? No, right?
No,
So
no.
essentially, for every dollar she's taking above her basis that's in gain, she's going to pay 20% in tax. Now, this
Okay.
scenario, she has $400,000 of gain, which is $80,000 of tax. So again, it's not that big. So that'd be option one. What's the other option? The other option is she could put some of that money into a passive real estate deal. And that deal could be about 200,000 or so, 250. And she could put it. In fact, we have a deal in Dallas, Texas, a multifamily property that provides what's called bonus depreciation or accelerated depreciation that could offset if she's an accredited investor. She needs to be accredited, right? So look up accreditation. So those are some of the two scenarios that I could think of right now.
Can you talk to us about a deferred sales trust? That really caught my attention because a lot of people talk about 1031 exchange, taking the profits from this deal and rolling it to another one and avoiding or deferring taxes. But I haven't heard a lot of people talk about a deferred sales trust. So that was very interesting. I'd love to hear more on this.
Yeah, most high net worth individuals, entrepreneurs, business owners, cryptocurrency millionaires, luxury primary homeowners, they struggle with capital gains tax when they go to exit their appreciated assets, kind of what we've been talking about so far. And it's somewhere between about 25 to 50% of their gain, depending on the state that they're in and depending how much depreciation or recapture they've taken. And so we use the Deferred Sales Trust, not to be confused with the other DST, which is a Delaware Statutory Trust or Delaware 1031, to give people tax deferral, liquidity diversification, and unlock freedoms to build wealth in a way that's transformational for them. So for example, this Deferred Sales Trust works for crypto, businesses, primary homes, investment real estate, can save a failing 1031 exchange. The other DST you may have heard of only works for investment real estate, doesn't give you liquidity, doesn't give you diversification. Essentially, it's a part of the 1031 exchange family. And by the way, I love 1031 exchanges when they make sense from our clients. I'm a broker myself, and we do 1031 exchanges. But to be honest, it hasn't made a lot of sense for a lot of time. And in fact, even right now, it's not making a lot of sense because you're seeing rising interest rates and cap rates that are pretty flat. And so people don't want to be in a negative leverage situation by overpaying for a property in a changing marketplace. And so we give the ability to access what's called debt-free freedom and diversified cash flow into multiple asset types, such as multifamily investments that are passive or by themselves, stocks, bonds, mutual funds, real estate development, hard money lending, essentially taking a piece of equity, moving it into an installment-like structure, which is what the Deferred Sales Trust is, where we can carry paper for the trust. So the Deferred Sales Trust allows a seller, for example, we just did a $29 million deal outside of Austin, Texas, for a client of ours who was exiting a large asset that he tied up in an assignment. And instead of taking the millions of dollars into ordinary income tax, since it was below a 1-year mark, we were able to use a Deferred Sales Trust to defer all of his tax. Now, once the capital is there, he can invest it into a couple primary homes. In fact, that's what he did, lots in particular, for portions of the fund where he's waiting to build when it makes sense for him, but he can also use the funds to build. So these are the types of advanced tax flow strategies that we help people with the DST to help them create and preserve more wealth.
I love that. That's amazing. Well, what is the process of filing a deferred sales trust or learning more, or somebody wants to, consider this as an option for them?
Yeah, I mean, I think the first thing is education, right? Our company, capitalgainstaxsolutions.com, you can go to our YouTube channel. You can download a ton of free content. You can get a free ebook. We got a new book coming out with Kevin Harrington from Shark Tank, which is going to be released soon. So just get educated. Yeah, get with Morad here. If you're looking to sell real estate and really hire the dream team is what I like to say, or build the dream team. And you might have already a dream team that you've been working with, but then we'd like to become a part of that, where we can help you decide if the Deferred Sales Trust is a good fit, but also explore your other options. Maybe it's an opportunity zone. Maybe it's a 1031 exchange. Maybe it's the Delaware 1031. Maybe it's a donor advised fund. Essentially, I believe everyone needs an exit planning coach, an exit planning expert to help you beyond just a CPA who does, tax returns. We work with, I think, some of the best tax attorneys in the country, and they're brilliant. And our role is the trustee for these trusts to help people execute on these things. So you just got to have a team that know how to do this, how to execute it, and how to make sure that you're set up to make sure the timing is correct. So we want to do it early. So you want to be early. You want to do plan. You want to do pre-planning. You want to plan your exit strategy before you list and sell the property, because the worst thing to do is to list and be running out of time, and now you're scrambling to see what strategy is going to work well. But guess what? If you move beyond certain positions where the buyer removes all contingencies, you eliminate strategies where we work on a conditional basis. So we can get everything set up prior to the buyer removing contingencies and give you an option to execute it, and maybe not if you don't want to use it. But a lot of people, our tendency is either we're not thinking about it, or even like yourself, Morad, people aren't putting the content out there for their clients to listen to and think about. They're just looking for the listing and not thinking about what's going to happen with the tax consequences. And then all of a sudden the client's put in a bad position. So it's my vision is to train and coach the top 5% across the country of business brokers, real estate agents, commercial brokers, financial advisors, and CPAs, the value of the DST, so that you don't get in a position where you're running out of time. Now, we can also save a failed 1031 if you work with us and our strategic alliance, who's a qualified intermediary. Because guess what, Morad? Not every real estate agent nor every QI company wants you to know about the Deferred Sales Trust. Why? Because we're a competitor to a lot of people's vision of just getting commissions. And by the way, I love commissions. I'm a broker. I still do them. Nothing wrong with that. Or the QI companies that don't want you to know about it because they want to keep you in the 1031 loop, right? So we provide that exit plan that truly gives you some of those freedoms that a lot of people are looking for right now, especially the baby boomers. I mean, we're in the largest wealth transfer in the history of the planet. And there's $32 trillion that's approximated it's going to transfer from the baby boomers to the millennials in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. In fact, there's 10,000 baby boomers turning 65 every day, and about 77 million in the US alone. So If you think about that, that's a staggering amount of wealth. And 50% of all of that wealth is tied to high-end primary homes, commercial real estate, and private equity or businesses. And so to the extent that this wealth is going to transfer, and we're on the front lines to help them in that transfer, we've got to have transformational exit planning for them. Otherwise, the government's going to take a lot of the tax, or the people just aren't going to sell. They're just going to say, forget it, I'm not going to sell. Why would I incur all of this tax? I'll just hold it and die and get a stepped up basis for my kids, which is also an option too. And so we're going to explore all of these options and then just help clients make a great decision for themselves and their families.
That is fantastic. I really appreciate your time and your wealth of knowledge. How can people get a hold of you?
Yeah, you go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. You can also search us on iTunes, YouTube. You can search us on Spotify, all the social medias. And then again, check out the new book coming out on Amazon soon, Building a Tax-Deferred Exit Strategy. And it's really our guide for helping you to unlock an ideal exit plan and wealth plan when selling highly appreciated assets for yourself or for your clients. We have our masterclass you can also check out. We have Expert Tax Secrets as well, which is .com, which is our coaching program for business professionals. So yeah, you just search my name, Brett Swarts, and Capital Gains Tax Solutions, and all of that stuff will come up.
Thank you so much for your time. Any final thoughts?
No, final thoughts would be don't get caught in a 1031 exchange without a backup plan, right? I'm getting more and more people calling us who want to use it, but they're with a QI company that either won't accommodate or won't cooperate with the Deferred Sales Trust. And so we just want to make sure no one's ever stuck. I'll never send a deal to a QI company who doesn't allow a third option, which is the Deferred Sales Trust. And so just make sure you're not putting yourself in 1031 jail. Those are the worst calls to have. So you want to get with Morad right away and connect you with me as well, or at least if you contact me, let me know that Morad, you heard this on Morad's podcast here. So that would be it. And otherwise, make 2023 an amazing year. There's lots of opportunities. You just got to have the liquidity and the ability to execute on these deals. And of course, the DST can provide and help you with that.
Thank you so much, Brett, for your time and your expansive knowledge on this topic. This was amazing. I'll be sure to stay in touch. We're going to post this. And if anybody has any questions, I'll be sending them to you.
Sounds good. Thanks, Morad.
Thank you. Have a great one. Thank you.
Goodbye.
That was great. Hope y'all enjoyed that episode for deferred tax strategies. Really love that. Let me know if you have any other questions. Have a wonderful week, and we will see you soon.